This is The Bottom Line. The Bottom Line on 938 Live.
A steady recovery in economic growth despite a disappointing start and the end of a huge economic stimulus program. Those are the key highlights of the world's largest economy this year. Travis Teo has a review of the US economy and what's in store for next year.
The huge asset buying program known as quantitative easing or QE finally came to an end in October. In total, the Federal Reserve had spent $3 trillion buying bonds to save the economy. And as the spending eased, the chief US economist at High Frequency Economics, Jim O'Sullivan, says the economy is shown it's able to stand on its own 2 feet.
The year started with, of course, a very weak first quarter GDP report, but it became increasingly clear that that was an aberration, probably related to the unusually severe winter weather. And GDP certainly bounced back pretty strongly in Q2 and Q3. Meanwhile, the labor market numbers continue to improve. I mean, the unemployment rate has steadily been coming down. In fact, over the last 12 months, the unemployment rate has declined by 1.4 percentage points to 5.8%. It's the biggest 12-month decline in 30 years.
Observers agree that the biggest factor for the US economy next year will be how and when the central bank will raise interest rates. Senior economist at UOB, Alvin Liu, says the 2 factors that will trigger the rate hike will be inflation and the jobs market.
Clearly, if the jobs market continue to improve at the pace we have seen in the last 9 months, that would have probably sufficed. On the other hand, there are concerns about a potential decline in inflation expectations. This concerns itself is not enough to shift the yardsticks in next year's rate hike timeline. We think that it's still going to happen somewhere in the middle of the year, around June period.
High Frequency Economics Mr. O'Sullivan says the Fed will leave lots of room when raising interest rates.
I mean, once they start, I think the presumption will be that they'll continue tightening for a while. I mean, typically, Fed tightening cycles last a while, and they don't make a move until they're pretty confident that more than one move will be needed. So I think markets have to adjust to that. So I think the clearest signal out of all this is that bond yields will have to rise fairly significantly. And in turn, I mean, I think that probably is a bit of a headwind for, say, the equity market.
Meanwhile, senior economist at Mizuho Bank, Vishnu Varathan, warns that while a drop in oil prices is good, too much might hurt the economic recovery.
We've actually seen private consumption picking up. That's a good sign because we don't have these types of cost pressures infringing on consumer spending. So that could actually boost the US economy further next year. The flip side to that is that if oil prices continue to drift much further down, then that could impede in the shale oil and gas industry. So if the construction and the investment and the output there slows down, that could be the unexpected dampener on US growth.
Still, the economy could come full circle next year. Economists like UOB's Mr. Liu is feeling a chilling sense of déjà vu with the recent cold weather.
It is very hard to really pinpoint whether this is going to be a very short term or it's going to last much longer than that and having a more material impact into the quarter like what we've seen in first quarter of 2014. That said, once things return back to normal itself, we do expect to get that strong rebound in terms of retail sales coming back after the weather has improved significantly.
The US is forecast to grow 3.1% next year, a faster pace than an estimated 2.2% this year. The Bottom Line is brought to you by Turkish Airlines, Europe's best airline.